Thank you so much, and good morning, everybody. Just absolutely delighted to be here with you. I have to say I'm always grateful for the opportunity to engage with Mainers, and no matter where the location, I have enjoyed a couple of visits up to Maine. It was one of my first trips, and I was there just a few weeks ago. I think it's a key part and one of the most interesting and also most enjoyable parts of my job is to visit around the First District, which is the district of the Boston Fed, which is most of New England. And so I plan to continue visiting and in particular look forward to many future visits to Maine. So I want to start by thanking two people. First of all, Jim Roche, who of course is president of the Maine Bankers Association. We at the Boston Fed really appreciate his continued engagement with us as we all work together to support a safe and sound banking system, as we all know is so vibrant so critical to a vibrant and inclusive economy. So thank you, Jim. Second, I also wanted to thank Jean Hewlett, who is president and CEO of the Maine Community Bancorp. Jean, of course, is a member of your association's executive committee. She's also a member of the Boston Fed's board of directors, and we truly appreciate her insights on economic conditions in Maine and New England more broadly, and appreciate all that she shares as a member of our board. So in the time that we have together today, I will make some initial remarks and then look forward to taking a few questions. Of course, I am going to share my views on the economic outlook and monetary policy. And then I'd like to provide a few perspectives on banking in New England and in particular in Maine, and then also to highlight the importance of all banks of all sizes to a vibrant, inclusive economy. And then I'll end with just a few points about the breadth of the Federal Reserve's work across the region and the shared opportunities that we have to collaborate in the public interest. So I'm going to start with my current views on the economy and the outlook and monetary policy, especially because, as Jim just noted, the Federal Open Market Committee, or FOMC, just this week, just a couple of days ago, met and made a decision about policy rates. But before I jump in, I do need to give my standard disclosure, and the views I'm going to express are mine. I'm not speaking for any other Fed policymaker. So our focus at the Fed does remain bringing inflation down to our 2% target. Price stability is essential for a well-functioning economy, and it's also an important precondition for maximum employment that's sustainable over time. And so reducing inflation, restoring price stability, really relates to both parts of our dual mandate from Congress. And as I travel around the district, including my trips to Maine, I continue to hear about the challenges that households and firms face related to too high inflation. On one of my trips to Maine, I remember hearing about residents who were unable or unwilling to move within the state to take job offers, due in part to the rising costs of fuel, shelter, transportation, and other necessities. And challenges in terms of finding workers has been something that we've certainly heard quite a bit about. However, there has been some promising news. Although still too high, inflation is down from its earlier peak. And there's some evidence that demand and supply are realigning, especially in labor markets. And this realignment is essential. It's really needed in order to reduce the upward pressure on prices. That misalignment has been one of the key things driving inflation. Importantly, our current policy, this phase that we're in at the moment, really, in my view, requires patience, allowing the time for us to better separate the signal from data that's actually pretty noisy, and I'll say a bit more about that. I'd like to say just a bit about the FOMC's decision a few days ago and the related economic projections, the SEP, or Summary of Economic Projections from policymakers that was also is now public. So as widely expected, the FOMC left interest rates unchanged. However, the policy statement makes clear that this decision need not imply having reached the peak for the federal funds rate in this tightening cycle. And future decisions will depend on a holistic assessment of incoming data. The FOMC, as I noted, also did release an updated Summary of Economic Projections, we call it the SEP, and it reflects perspectives from all of the Fed Board's governors and also all of the Reserve Bank presidents, and it reinforces the message that's in the statement. The SEP's median expectation for the federal funds rate features one more 25 basis point increase this year. And relative to the projections that were issued in June, it has a more gradual process of policy normalization through 2024 and 2025. This federal funds rate projection underscores the committee's focus on restoring price stability while also recognizing that other part of our mandate, maximum sustainable employment. The median SEP forecast expects a normalization of labor market conditions that contributes to inflation running at levels that are consistently close to target by 2025 to 2026. So I fully support the FOMC statement, and I agree with the policy guidance that's part of those SEP projections. My expectation is that rates likely will need to stay higher and for longer than previous projections had suggested, and further tightening is certainly possible. Policymakers will stay the course to achieve the Fed's mandate. My views on policy reflect my assessment of the current conditions and the outlook for inflation and real activity. And I did note earlier that there are some promising signs that inflation is moderating and the economy is rebalancing, and that's very welcome. But progress hasn't been linear, and it's not evenly distributed across sectors. So starting with inflation, I'll focus on what we call core inflation, which excludes the volatile food and energy components. Those are clearly really important, but we focus on core that excludes them because it's typically a better gauge of the underlying trends than total inflation is. So recent readings for core inflation, as I've said, have been encouraging, but if you disaggregate the key components, you get some valuable insight into the recent pricing patterns. And in particular, doing that highlights that most of the moderation in core inflation has come from a noticeable decline in core inflation for goods prices. And that really reflects the resolution of many of the supply bottlenecks and constraints that we're all familiar with. A second key component is shelter inflation, so related to housing prices and rents. And that's also moderated recently and will likely ease further as slower growth in new market rents is reflected in the overall index. Again, I don't expect it to be linear, but I do expect that to continue to decline. However, inflation in core services excluding that housing or shelter component, which actually accounts for more than half of that preferred core inflation measure, that has yet to show the sustained improvement that would be consistent with price stability. And that's a core reason for my focus on patience as we stay the course in order to restore price stability. So while there have been promising developments, it's really too soon to be confident that inflation is on a sustainable trajectory back to the 2% target. I also want to note the importance of caution in reading too much from individual data points or even from a few months of information. The monthly inflation data, as an example, have always been pretty noisy, pretty variable. But the variability of core inflation has actually increased since the pandemic. And considerable uncertainty remains around the underlying inflation conditions. So extracting trends and patterns from that very noisy incoming data is going to take patience. I've also noted that sustained reductions in inflation will require demand coming into better balance with supply across the economy. And there are signs that a broader rebalancing is underway, particularly that can be found in labor markets. So labor markets are still quite resilient overall, but they're cooling. In particular, the pace of hiring has slowed, although remains above trend. Job vacancies have also declined, and quit rates are actually nearly down to their levels pre-pandemic. Also contributing to the labor market rebalancing is an improvement in labor supply. Indeed, we've actually seen some very encouraging recent increases in labor force participation, especially for prime age workers who are those aged 25 to 54. So over time, labor market rebalancing should result in wage growth that reflects, in addition to productivity gains, cost of living increases, again, that are consistent with the Fed's 2% target. And such rebalancing should contribute to a moderation in inflation in the context of maximum employment that's sustainable. So that brings me to my outlook for the economy. Monetary policy has tightened considerably to date, and we've raised rates to the range of 5.25% to 5.5%, leaving them unchanged at this last meeting. But economic activity has been resilient, and it may take longer than usual to see the broader economic impact of those monetary policy actions. In particular, demand may have been less sensitive to higher interest rates so far, because policy tightening has occurred amidst business and household fundamentals that are sound compared to previous cycles. Many firms have been insulated from the rate hikes because they extended the maturity of their debt when rates were very low, and also because of higher profit margins. But cash levels are returning to pre-pandemic norms, and debt market activity is picking up. On the household side, household excess savings accumulated during the pandemic but are and have been declining, while reliance on credit card spending is rising. And this all suggests that businesses and household spending is likely to become more interest sensitive, helping to temper demand growth and helping to realign it with supply. I do continue to expect that the full effects of monetary policy will eventually show through and put inflation on a sustainable trajectory back to 2%. But I'll note that the timing and ultimate impact of policy tightening to date does remain uncertain. Historical evidence is largely based on experiences in which policy rates moved up more slowly than they have in the current cycle. So in all, the economic circumstances surrounding the pandemic and the recovery have been and continue to be highly unusual, and that has important implications for policy setting. So, as I've now said a few times, this phase of our policy requires considerable patience, enabling policymakers to better extract the correct signal from the incoming data, allowing some factors that have been supporting the near-term activity temporarily, allowing them to play out, and also recognizing that the risk of inflation remaining persistently high has to be weighed against the risk of activity slowing more than anticipated. And I also recognize the potential for higher short-term rates to place more pressure on some banks' balance sheets and reduce bank credit provision more than anticipated. So I continue to be what I call a realistic optimist. I'm realistic about the uncertainties and the risks to my baseline outlook, but I'm optimistic that price stability can be restored with an orderly slowdown in activity and only a modest unemployment rate increase associated with supply and demand in labor markets coming into better balance. And importantly, the ongoing resilience that I see in the economy and the progress so far on inflation lead me to believe that the pathway to achieving that desirable outcome has widened. Policy remains well positioned to proceed cautiously and resolutely in this uncertain economic environment, recognizing and balancing the risks while remaining data dependent and focused on restoring price stability with the flexibility to adjust policy appropriately as conditions warrant. So I'd like to turn now from the national economy to Maine's economy. And in my recent visits to your state, I've spoken with a wide range of people and learned about some of the unique challenges and also economic strengths. Challenges include the fact that Maine has a population that's older and that's aging faster than the New England region and the rest of the nation. And that reality tends to reduce the availability of labor, which is something that businesses, both large businesses and small businesses, mention frequently. Access to affordable housing also remains a major issue. Maine employers told me about their difficulties finding and hiring workers for needed roles, in part because prospective employees are unable to find affordable housing in the area. And I know that expanding access to broadband in Maine's rural communities has been a challenge and remains a priority. I've also learned about Maine's many wonderful economic strengths. Among them are the state's rich natural resources on land and also, of course, in the Gulf of Maine, as well as strong retail and healthcare industries, robust tourism and hospitality sectors, abundant small businesses, and a really strong sense of community and a place of pride. And again, I've truly enjoyed my visits to Maine. Another strength, of course, is Maine's banking industry. Your banks employ as many as 9,000 Mainers, serving households and businesses across the state in communities small and large. Of course, banks do face challenges in addition to those in the current interest rate environment. Evolving customer preferences require increasing investments in technology, and you're seeing increased margin pressure related to competition for deposits and competition as well from new market entrants. Today, I do want to recognize the critical role that banks of all sizes play in creating a vibrant, inclusive economy. Community banks like those in Maine have remained resilient and continue to leverage the close working relationships that they have developed within smaller cities, towns, and rural areas. Community banks provide a critical source of funding for small businesses, which are a key kind of employment driver in communities across our district. Community banks also provide sorts of funding for small businesses. And this was demonstrated, for example, during the implementation of the federal government's Paycheck Protection Program, as community banks played a major role ensuring that those funds reached businesses, and that was a wonderful partnership and greatly appreciated. Fed Chair Jerome Powell has noted that a robust and dynamic banking system, along with effective and efficient regulation and supervision, does help to ensure that banks of all sizes can meet the needs of households and businesses in every community throughout our country, in good times and in challenging times. And I fully agree that we must preserve and build on these strengths and also on that diversity. Finally, let me say a little bit about the Fed's activities. I like to say that our overarching mission at the Boston Fed is supporting a vibrant, inclusive economy that works for everyone, not just for some people. As you know, an economy's strength has many dimensions, so the Fed has a broad portfolio of activities and engagements, all in the public interest. This includes monetary policy making, and I've talked a bit about that, economic research and analysis, bank supervision, financial stability work, serving as a lender of last resort for banks, community and economic development activities, and initiatives in infrastructure related to payments, technology, and finance. And all of those support our mission and our mandate, and many of them are done in collaboration with institutions across our region. I'll very briefly mention some of our work to support economic vibrancy in all areas of New England with the goal of expanding opportunities for everyone to participate in the economy. Since 2014, we focused on encouraging local efforts to find economic resurgence in smaller cities and rural areas that are facing long-term struggles. We call that the Working Places Initiative. It's based on research that shows that an essential element of place-based economic resilience is collaboration across sectors, leaders in different sectors, local individuals who are willing to come together to take on the shared leadership challenges to define problems and really identify and implement solutions. In Maine, there are local efforts in 6 areas: Greater Bangor, the Katahdin region, Lewiston-Auburn, Maine Highlands, Saginaw County, and in Washington County with the Passamaquoddy tribe. The Fed's work helps the local collaborative networks emerge and flourish. We find that people really do want to work together to solve problems. And I suspect that's because improving opportunities for people and places to not be left behind, but rather to join in the economy is good economics, it's good citizenship, and it's good business. And I'm really encouraged that local, tangible efforts like these are adding up to create real strength across our region. And I know that Maine bankers work to provide the services and the credit that help communities prosper. And at the central bank, we certainly look forward to continuing to collaborate with you in the public interest. So in conclusion, I'll say that the privilege and responsibility of a policy-making role like mine makes frequent engagement with stakeholders essential. So I will continue to prioritize taking cross-sector visits to each state in New England, and certainly continue to visit Maine, and hearing from those in a wide range of roles who make up and shape our economy and our financial system. Since its inception 110 years ago, and by its very design, the U.S. Central Bank has deep and varied interactions with banks and with bankers, ranging from safety and soundness to payments infrastructure, to credit access and economic development. And I look forward to continuing to work with you to support the people and places of Maine, New England, and the nation with a vibrant, inclusive economy and financial system. So I'd like to thank you again for inviting me to join you here today. And now I look forward to joining Steve DeCastro for some questions. Thank you again.
Before we get started, you have some note cards on your table. If you have a question you'd like to ask Dr. Collins, please feel free to jot that down, and we'll have some folks around the room looking to pick up those cards from you. I do have some prepared questions, so no immediate pressure. Well, thank you, Dr. Collins, for giving us some insight into what's been going on in the past year and a half for the Fed. I think for our audience, it'd be really interesting to have you take us behind the curtain a little bit and talk about, logistically, what does the meeting protocol look like at the Fed, and unlock that mystery for us.
Yeah, absolutely, and that's actually a question I get asked a lot. So at the meetings, the governors and the Reserve Bank presidents all come together, having done quite a bit of preparation in advance to really study and understand economic trends and what's happening. For me, that involves data analysis. I am a bit of a data geek, looking at implications of models, and also many of the kinds of conversations that I was talking about, pulling it all together. So we've all done quite a bit of background work. And when we come together, in addition to hearing some briefings from the board staff, we have a go-round where we each summarize our own view of the economic outlook, and then a second go-round where we each talk about what we think is the appropriate policy recommendation before ending the meeting with a vote on which direction to go forward. And I will say that it is a collaborative group. I'm not surprised, but have been really impressed by the substantive nature and very engaged nature of the engagement on what are really important issues and decisions.
Do you find in those conversations that, maybe you came in with a certain set of perspectives or views, and those evolve as those conversations happen?
So I will say that I certainly learn a lot from my colleagues, and it's a complicated environment that we live in. I think we all need a bit of humility to understand that there's quite a bit to learn. These are unusual circumstances. And some of those conversations, of course, are ongoing. They don't only happen at the meeting. And so I absolutely would say that I've learned from colleagues, and will continue to do that, and also continue to share my perspectives in terms of what I'm seeing and what I'm hearing.
You touched upon in your comments credit tightening, which is a topic very important to our group here. I'm just curious where that sits on the table with the Fed, and it's a delicate balance, I guess. So as the tightening occurs and credit tightening happens, it causes a little stress on the banking system. So maybe talk a little bit about that.
Yeah. So of course, our immediate, our focus with our congressional dual mandate of price stability and maximum employment, that requires us, as we think about a vibrant, inclusive economy, to really look at all of the various connections. And as I mentioned before, I see a very clear pathway to an orderly slowdown enabling the rebalance, and that would imply, or that would require, an orderly adjustment in financial conditions as well. And so it is certainly true that one of the ways that higher policy rates are transmitted through the economy involves the overall credit conditions, and bank activity and bank behavior is, of course, very important for that. And so it's something that we certainly are following closely. And as I said in my remarks, and we'll say again, we do see a lot of resilience, and there's a lot to make sure that we continue to monitor and to focus on in a variety of contexts.
Yeah, and I'm also curious, regionally, how the team balances that, where maybe one region having different challenges than New England, for example? How does that dialogue happen?
Yeah, so, the structure of the Federal Reserve, of course, does have 12 different districts, and there can be differences in dynamics, in trends across districts, and even within districts. I mean, different parts of our district, different parts of other districts can be somewhat different. I will say that from the perspective of our district, we are monitoring closely. We have strong relationships with banks across all of the states that we manage, that we supervise. Again, that's something that we will continue to do carefully. And there are a lot of conversations, and there are some supervisory groups that are across the entire system, and a lot of engagement so that there is understanding about what challenges are being faced where. But again, what I see is quite a bit of resilience, and that's certainly true for our banks in Maine and across New England.
Yeah, appreciate that. Do you have any thought around, we've got student loan payments starting back up? I mean, at the Fed's level, what level of concern is there around that and credit card debt and those types of things?
So we're focusing on all of it. I think of a really big jigsaw puzzle that has lots of different pieces, and they all fit together, and we're trying to understand how they evolve. Some of it, you can't predict exactly how things will unfold, but we do have models, and we do have historical understandings, and there's certainly things that we are incorporating as we make our forecasts, and certainly looking at the context with student loans is one of that. There are many kinds of trends that have significant effects on parts of our economy, groups of individuals that may have a smaller kind of national impact, and it may unfold also over time. And so that's certainly one of the things that we're watching very carefully, and does factor into the calculations and discussion.
Great, thank you. So just shifting the conversation a little bit, we had a couple bank failures earlier this year, and in a way that separated our industry a bit. When you mentioned you had some, I appreciate your comments about the state of Maine. We have a lot of community banks in Maine. Yeah. There was concern that deposits might be leaving for money center banks. And so I'm just curious how the Fed, takes that into consideration in terms of the deliberations.
Yeah, and so again, as part of an orderly slowdown, the role of the financial sector is really important for that. And so that's certainly something that is part of the broader context that matters. That's quite important. I will say that there are aspects of how things are unfolding that do make the context more competitive. And the increased competition for deposits is something that I know I've heard from bankers in Maine, and is something that we're hearing across the nation more broadly. It's also true that the relationships that community banks have built up are, provide an opportunity to leverage and to manage some of that competition. We're seeing evidence of that as well. And so, again, I think a dynamic system that serves our broader community does involve banks of all sizes, and there are kind of different models as we think about what that vibrancy will continue to look like.
Well said, thank you. I have a couple more questions, but I'd love to open it up to the audience if there are any questions out there at this stage.
Any questions?
I'm Todd Baker. I'm with Partners Bank. And my question is, can you comment on the plans and expectations for quantitative easing? And maybe you could tell us how you view the results and the risks of that program?
Sure. So I'll say a little bit about that. As you know, in the background, we continue the runoff for our balance sheet, and that is continuing. You know, at some point down the road, there, you know, will be some future discussions, but at the moment, the plan that had been announced is still being implemented, and I do expect that to continue. You know, I mean, those changes do have gradual implications in terms of overall credit tightening. You know, hard to measure exactly how large they are, but that's certainly something that we factor in. And is something that, again, we're monitoring as, you know, different dynamics are happening across our financial sector. You know, we're monitoring risks there as well. But again, the policy for the runoffs that was announced some time ago is continuing, and I do expect that to continue for some time.
Got another question from the audience?
Hello, I'm Ed Gardner from Norway Savings Bank, also a real estate agent in Portland. Coming out of a really hot real estate market, and now we're seeing a lot of price reductions happening. As people's loans mature this year and they have to refinance, and they can't afford a higher interest rate, are you forecasting any foreclosures or short sales in this future market?
So there's clearly a lot of attention to housing markets, and so let me say a couple of things about that. And there's some national trends which we also see in Maine, across New England, and then there's some things that are a little bit different. You know, the housing market is one of the first places that when you start raising interest rates that you see an impact, and that's exactly what we did see, that you know, mortgage rates increased very quickly, and what had been a very hot labor market, you know, I have to say in part as people across the country realized just how beautiful Maine is, there was a real increase in demand here. Housing prices, this was one of the areas where housing prices rose particularly quickly. And it's certainly true that as rates increase, there are, you know, a number of individuals who might have put their houses on the market who have not. And so the inventory, and this is true nationally, it's certainly true in New England. The inventory is really very, very low, and that's influencing prices, et cetera. We are seeing that new home sales are quite robust. It's just the inventory is so low that there are not as many of them. And while housing prices nationally have been moderating, the inflation there, it's been relatively higher in Maine compared. Maine and Vermont are, within New England, the states that have had the highest increases. So there are some differences there, and some of that certainly does have to do with supply. So are we carefully watching and trying to understand how that market is unfolding? Absolutely. We're also trying to see how long it's taking for the interest rate increases to kind of show through more broadly across the economy. They clearly, pretty quickly, had implications for housing markets. And again, that's something that we continue to watch.
Thank you. Any other questions at the moment? All right. So, Dr. Collins, you mentioned sort of a broader portfolio for the Fed and touched upon a couple things, but maybe can we double click on that, hear a little more, and then as a follow-up to that, it would be interesting to hear about FedNow and kind of what's going on with FedNow.
Yeah, happy to talk about both of those. So let me first say that, and I knew a lot about the Fed before I took on this role, but you know, having been a director for many years in Chicago, but I didn't even fully understand the breadth of what we do, and I think that most people don't. So of course, monetary policy is a core focus, and that's perhaps what, you know, most people know us for. We also do a wide range of types of economic research as a kind of analytically rigorous, nonpartisan partner. We can really provide a resource to many by helping to better understand aspects of our economy. And just to give a couple of examples, childcare is an economic issue. Quality, affordable childcare, which is a real challenge for parents who, you know, to provide for those who either want and or need to be in the labor force, providing options. That's a real challenge, and it's a long-standing one, which the pandemic seems to have exacerbated. And so that's one of the areas that we see as important in terms of understanding what a vibrant, inclusive economy looks like. So it's one of the things that we're looking at. I mentioned the Working Places Initiative, which focuses on trying to help smaller cities, rural areas that have long-term challenges find resurgence. We also have work on housing, which was mentioned earlier. And I could go on at length. I'll mention one other quickly before I talk about FedNow briefly, and that is our New England Public Policy Center has a recent paper trying to understand better some of the challenges climate change is likely to place on local government finance. As our climate gets hotter and stormier, what are some of the implications for the cost of public services? And that would ultimately affect taxpayers. So that gives you a sense of the breadth of some of the kind of work that we do. In terms of FedNow, that is a very recently launched initiative. I still remember when checks were really common, and we actually took the time to fly paper checks around the country so that they could, clear the banks that they were drawn on. The Boston Fed, with other partners, was part of moving to a digitized clearing system and expanding automated clearing. And then most recently, we've been really taking the lead in developing the first new payments rail, which is FedNow, that will provide the opportunity for 24/7, 365, instant payment settlement. And it's a payments rail that, of course, is available for all banks across our country. We have, in the first 2 months, I think we have over 70 financial institutions that have signed up and are now engaged, and I think over 20 service processors. And so, we are excited by the use cases that they're finding, everything from the idea of parents helping to be able to, instantly help out that new college student, as well as issues for small business and a whole range of different ways, but also our increasing desire for faster payments, and that's something that this provides an opportunity for. So we hope to see increased engagement with the system, and are working closely with banks across our region and, of course, across the country to move in that direction. And we expect the usage to continue expanding, and it's something that we're excited about. So thanks for asking about FedNow. Absolutely.
Yeah, an important development for our industry. Yeah, Jim.
Hi, Dr. Collins. My name's Jeff St. Laurent. I'm with Saco and Biddeford Savings. And I was curious, how challenging is it to accomplish one of your mandates of price stabilization, while at the same time there seems to be an endless supply of dollars being generated for various things like the pandemic, the war in Ukraine, and other natural disasters?
So, our focus is on monetary policy, and of course, a range of different other things that are happening in the economy have an impact in terms of our outlook and in terms of how we are, how we're seeing how things are evolving, and therefore what our role is in terms of achieving our mandate. And so that certainly is something that we look closely at and that we continue to study, and are focused on the pieces that are our mandate, which is price stability and sustainable maximum employment. And as I mentioned, I really see those as working hand in hand together. I'll just say one thing quickly, which is, to me, price stability means that you have low, stable inflation that no one's even thinking about, and that's where we were for a while. That's absolutely not where we are now. It has come down somewhat, but lots of people are still very focused, understandably, on the very high inflation. So that's really what the emphasis is. And of course, we have to make our decisions having taken a holistic review and careful analysis of the range of things that are happening in the economy.
Great. Other questions?
Good morning, Dr. Collins. My name is Mike O'Connor. I'm with Bangor Savings Bank. And with the Bank Term Funding Program about halfway through its life cycle and unrealized losses remaining elevated in most banks' bond portfolios, has there been any discussion at all around extending this program?
So, I think we'll have to see where that goes. I mean, there's not really more that I can share in terms of what that direction would be. I think the ability of the Fed working with Treasury to very quickly stand up a facility that could really support liquidity was extremely important, and there's a lot that we can learn from that, and we certainly will continue to focus on that and to learn from it.
All right, one final question for you, Dr. Collins. You've come to the Fed with a distinguished academic career, and I'm just curious, kind of from your perspective, how your history in academia has helped you with the various responsibilities at the Fed.
It's interesting because from where I sit, my current role actually brings together kind of three of the core things that have been important to me throughout my career. One of them is as a policy-oriented macroeconomist, and early in my career I was mostly focused internationally, and over time a lot of focus on this country, on the U.S. as well. And that's central to the work that we do. Also as an educator, I cared deeply throughout my career about supporting young people, supporting workforce, and that's certainly also important. And I actually take seriously the opportunity to help explain, at least from my perspective, what we're doing, why we're doing it, and to take the time to answer questions. And then also being really focused on a large organization with a public mission. That's also been important to me. I was provost of the University of Michigan. And so my current role really bring those together. When I first stepped into the role, it really seemed to me a privilege, a responsibility to be making such critical decisions that impact people across our country. And I take those very seriously, but also an opportunity to work in partnership with other organizations to really foster that vibrant, inclusive economy, and an opportunity to make sure that we expand the voices that are heard, who we learn from as we understand the challenges we're facing, the opportunities that we have to really address them. So, that continues to be how I think about it, and it's just been really wonderful to work with a team of such dedicated experts across the Boston Fed and more broadly across the Federal Reserve System, and my colleagues, and to learn, and there's still a lot to learn, as I said, continuous learning. So to me, all of those come together, and again, it's a privilege, it really is a responsibility, and it's also an opportunity.
Do you have any reflections on your year as running the Boston Fed?
Yeah, so one is a tremendous amount to learn, and I am a lifelong learner. That's kind of one of my mindsets. We'll continue to do that, as I said a couple of times. Really unusual times, a lot to understand better, and I think we need to continue recognizing that we are learning, and to have a bit of humility, I think, is really important. And again, the breadth of the work that we do is, to me, exciting and invigorating, and an opportunity to work with strong partners, and that certainly includes the banks across our district, and public sector, private sector organizations, civic organizations, in order to foster that vibrant, inclusive economy, which, again, I see as our overarching mission. So the opportunity to do that has really been tremendous. And I think we can all roll up our sleeves and keep moving forward to accomplish that broader mission. I do want to say again, it's been a real pleasure to spend some time here, and I look forward to many other opportunities to visit and talk with Mainers.
Well, we certainly appreciate you taking the time to meet with us. It's been a pleasure, and thank you for all you're doing for our economy here in New England.
Thank you.
Thanks.
Thank you very much. I'm going to keep my